Hello. So, in the first chapter, let's understand how the demand supply equation, which is a key construct for a lot of organizations, might be something which you in the financial modeling space will want to model. So, let's say you are Tata Steel and you are not very sure that if you are manufacturing 10 million tons of steel this year, will that be consumed by the local demand, or will imported China steel be cheaper, and hence traders are going to shift to that, and hence you might have erratic swings in your demand. What will be the outcome of such market turbulence is something which the financial model is going to tell the board of directors of the company. Hence we need financial model to kind of forecast all the rights and wrongs, all the red flags, the yellow flags, and the green flags that can emerge in the organization. So, what is the potential use of the financial model? The main thing is generating the revenue and expense forecast. That is of critical importance. So, for a Swiggy, when I'm preparing a financial forecast, I will look at where is the top line coming from, where is the company earning its dollar, and where is the company spending it. So it is spending it on restaurant promotions, on advertisements, on delivery boys, and where is the revenue coming on commission share from restaurants, on the Swiggy Prime, these advertisements. So the entire revenue and the expense side needs to be populated. This will help the company understand how much cash will it have for the proposed capital expenditure, which is envisaged in the next 5 years, as well as the debt service obligations of the company. So for example, I am a steel company. So I want to understand that if I have lined up a capital expenditure of 20,000 crores in the next 5 years, does my operations give me enough leeway to go for that kind of a capital expenditure or not? Or will I be actually able to repay my debt or get into insolvency? So that is something which is very, very important. So once we build calculations which depict a real life situation, we can quantify the inputs and outputs of our operations. So for example, the entire Uber ride, right from the time a customer books that till the time the journey gets completed and money gets deducted from the wallet of the customer, that entire journey has got a lot of inputs. The more refined a model I need to make, I will have to increase the quantum of variables and scenarios into the model. So as I continue to add the variables and scenarios, it takes the shape of a model. So when I'm modeling in the city-wise number of trips, the prime cars, the go cars, the Uber pool rides, the more complexity that I build in the model, the more robust it becomes, and it helps us take structured decisions about the company. Now, how does that help? So for example, if the financial model tells me that the revenues are not as robust as one would expect it to be, then I will improve my marketing efforts or adopt cost rationalization initiatives. So once I reduce my costs, you will see that, okay, now things are much under control. So it's the financial model which raises these red flags, that I'm not earning enough revenue, or my costs are much higher than what the revenues can support, and hence I can reduce my cost. Then I have to probably scale down capex plans. So if the company requires, let's say, $1 billion for its capital expenditure, and the operations are throwing up just $500 million, so then the company knows that it cannot go for that entire capital expenditure. Or maybe if there are two competing projects, it can take only one of them. Or for example, if a startup is there, it can only venture into one of the cities instead of the two cities that it was initially planning, because it does not have enough capital, and hence it also needs to scout for additional funding, series A, series B, etc. So therefore a financial model gives this crucial input to the investment managers of the company, that how much capital is required, how much further capital infusion is required. And maybe if I can forecast that there is not enough demand which I will not be able to sell, probably I will do a production cut so that I don't end up piling up inventory, which is so dangerous in the case of steel, in the case of garments, whatever, a fast moving consumer goods. So the financial model helps the management of the company undertake a lot of contingency measures. So while the measures as outlined above can vary according to the unique business dynamics across the various segments, once I create a finance model, it will help the management cope with the uncertainty and focus on the value creation process. So once there is a robust financial model in place, the companies can analyze the geographies, the complexities of the various geographies. For example, when I was in Tata Steel, I would prepare forecasted financial statements for Europe in euro and pound, for Thailand in TBS, that's the baht, for Singapore in SGD, and then the Indian operations in INR, and then look at the overall consolidated financial statements. Every geography has different complexity. Europe might be going through recession. Asia might be having a major demand because it's a fast growing country. India has got competition from, let's say, a JSW. In the financial model, I can actually robust manner capture all these complexities, consider multiple currencies, and evaluate various capacity as well as capacity utilization combinations to find out what is the optimal capacity that I can create. So capacity expansion and capacity utilization are two very important components which the financial model tells me, right? So is financial model a science or an art? So once you build financial models, it's a very creative activity. One would want to believe that since there are many ways, for example, to write a book, is writing a book an art or a science? It will, yes, require a lot of extensive knowledge in MS Excel, but then what distinguishes a bad financial modeling guy from a good financial modeling guy? And then an excellent financial modeling guy, what is it style of an individual? So as to promote the theory that yes, there is an art element as well involved. So in financial modeling, you also have some sort of an art. The purest MS Excel guru or the financial theorist will tell you that it's the ultimate form of professional expression. So you have to live and breathe a model. So the kind of models that I have made in the last 12 years, I actually have lived those models. I know each and every cell, and they've gone multiple iterations. Financial modeling is not just the one time on activity. There are multiple iterations that keep happening before the final model, which is ready to be used by the management, is used. It's part science and therefore part art. Maybe the art is just 10%, but since there are a lot of judgments about the future that are involved, it can even change valuation from $1 billion to $10 billion. There are many variables that impact valuation, and hence I need to assign what weightage is important. For example, growth of India. There are a lot of factors that can influence growth. External macroeconomics, rupee depreciation, internal population, China factor. So what is the weightage that I assign to each? It's a matter of judgment. No computer can actually populate those kind of weightages. So I, as a financial model, need to be a good mathematician as well as someone who can think creatively. So I'm a fortune teller, by the way. Yes, I can read a situation, ask the right questions, assess what could be the potential roadblocks, and identify where the company can go wrong. So it's a very important thing. The process has to be very deliberate. You kind of need to step into the shoes of the user and play the devil's advocate, trying to capture all the reality that could seep in and jeopardize the plans of the investor. So you need to have that kind of a Steve Jobs kind of a confidence when you are with your investors. That's the kind of confidence the financial model should give you. No matter how difficult the questions that they pose, you are there with the nitty-gritties of how an external event is going to impact financial performance of your entity. Plus, you need to make it simple so that it's not just you, but anyone in the organization who can actually look at the financial model and decipher. It should not be very individual specific. If you are really wanting to become an excellent financial model guy, you need to have simple, scalable, and robust financial models. So what's the concept? So let's say if you're wanting to build up a power plant, so this is the final power plant that's going to be built over hundreds of acres. Now you will have a miniature working model of the power plant representing the same, so that you can look at the various construction stages and appearance. So this you cannot really build up in a day. This you can, and then kind of try to decipher the ramifications of building this kind of a power plant. So that's what a financial model does. It kind of builds up that reality before it actually happens in the form of an MS Excel construct. So that's the beauty of a financial model. So it's a simplified representation of a company's performance, both the past as well as the future. It's the task of building an abstract representation of a financial decision-making situation. I anticipate performance and I build that in my financial model. I kind of simulate the cost, the revenue relations to support the business, and I prepare it whenever an organization is considering, let's say, project finance. So when the banks give you money, they need a financial model. When I bid for a project, let's say as part of the insolvency and bankruptcy code, I need a financial model. When I'm looking at an M&A target, I need a financial model. If I'm looking at periodic financial planning, that's what I need, as well as conducting capital structure studies. So what will be the kind of capital that is more conducive in the current form? For example, if the business is not likely to do well, as evidenced by the financial model, I need to go for a higher component of equity, because if I go for debt, then how do I service the debt? Because the business is not likely to give me enough cash flow to service that debt. So an important capital structure decision can also be done with the help of a financial model. So what is the schematic diagram for a typical financial model? A well-designed financial model will have a clear purpose, flow intuitively from inputs to the final outputs, and is well documented. So you'll have all the model parameters, the macroeconomic inputs and sensitivities, for example, crude oil price, the rupee dollar forecast, the rupee yen forecast, the government of India interest rates, etc. So there are a lot of input sheets related to my operations. For example, if I am Uber, number of expected riders, number of drivers on the platform, incentives that I'm going to give, diesel prices, etc. So all these kind of inputs here are going to get into all the computation of the business, eventually leading to a profit and loss calculation for the business, right? Because that's where the money is being generated. From this, you derive a balance sheet for the business, so that you can look at aspects such as debt to equity ratio and interest coverage ratio, etc. So you kind of calculate interest on your loans. You do the cash calculation. So every month you are either going to be cash positive or negative after considering your investing, financing, and operating activities. So all the based on that, you finally build up profit and loss, cash flow, and balance sheet in the model. So the core elements of the financial model will be revenue. Where do I generate my business? Money, where is the dollar earned? How much from each stream? So for example, if I'm a steel company, from long products, from flat products. If I'm Airtel, how much is it from broadband? How much is from postpaid? How much is from prepaid? What is my cost of goods sold? The cost of selling your product or services, my employee cost, the cost of towers in the case of Airtel, marketing and advertisement cost, OPEX, which is also there, day-to-day operations, how do I sustain them? There is spectrum that I need to buy from the government of India. So how much is the money that I need to pay? That's the part of my OPEX. And I have got income statements then, which I looked at here, my profit and loss account. This is something which I am building here in terms of the profit and loss account. Cash flows, because ultimately cash is king for a business. No matter whether you're profitable or loss making, you will be able to survive as long as you got cash. There's no point making sales to a customer who eventually does not pay or pays after 2 years. So cash flow is that check which the business is going to look at. Then I'm going to look at my capital expenditure, either acquiring new assets or upgrading existing ones. Then I'm going to make my balance sheet, my assets, liabilities, shareholders equity, and also look at my working capital, my current assets as well as current liabilities. So this, friends, is a basic representation of a financial model. You input all the macroeconomic inputs, the sensitivities, all of these calculate to eventually lead up to the profit and loss account and a balance sheet, interest calculation, eventually leading to your report. So that's how it is. Thank you so much. Bye-bye.